Happy new tax year and welcome to the podcast from Morningstar UK, the leading provider of independent investment research. This week we bring you a comprehensive guide to planning for retirement. The problem with investing for retirement is it seems a very long way off for many of us. The state pension age is now 67, with average life expectancy at 80 years. Seemingly, more pressing financial obligations call out to be prioritised: children's education, family holidays, DIY. But start investing for retirement early enough and the burden is far less. Put off saving into a pension and the sacrifice you must make to meet the same financial goal is much greater. Let's start the podcast off with the basics. Emma Wall, Senior Editor for Morningstar.co.uk, explains what a pension is and why you should have one.
What is a pension? A pension is a savings plan which will provide you with an income in retirement. There are several different types of pension, one of which is provided by the government, one of which is provided by your employer, and one of which you can manage yourself. The government pension plan is funded by national contributions, or NICs. These are paid into a pot automatically from your pre-tax wages. Once you reach state retirement age, these contributions are then given back to you in the form of your state pension. You currently need to pay NICs for 30 years to qualify for the full state pension of around £150 a week. The workplace pension plan is also funded by contributions made from your pre-tax wage. There is a legal minimum contribution made by the individual, and then this is matched by the employer and topped up by the government. In the past, you had to opt in to a workplace pension scheme, but since October 2012, workers have been automatically enrolled in these savings plans. When you reach 55, you can have access to these retirement savings. The first 25% can be withdrawn tax-free, but after this you are liable to pay income tax on withdrawals. The third type of pension is called a self-invested personal pension, or SIP. These can be managed by the individual on online investment platforms. You make contributions from your post-tax wages, but the government then tops up your contributions with the income tax you have already paid. These savings are also accessible when you reach 55. All of these types of pension are invested in the stock market while you are making contributions, also known as the accumulation stage of retirement saving. The investments are chosen and managed either by a third party in the case of the government and workplace schemes, or by the individual with a SIP. The aim is to steadily grow the pension pot in order to maximise the amount of money the individual has in retirement and provide an income for the rest of their life.
Investing well is key to building up a sizeable pension pot. If done correctly, investing can also help you buy a property or pay for your children's education. So can you afford not to invest?
Since the credit crisis, consumers have been battling the rising cost of living, coupled with little or no wage inflation and poor returns on cash. While it may seem impossible to find the spare cash to put money away for a rainy day, it is increasingly important that individuals think about their long-term finances. The public purse is under pressure, and the guarantee of a state pension in retirement for those currently aged 35 or younger is questionable. For those that will receive a retirement income from the state, ask yourself, is £100 a week enough to live on? If it is not, you need to take steps now to provide yourself with extra income in retirement. Inflation erodes the power of your pound. Since 2004, inflation has ranged from 1% to more than 5%, but at its peak in 1975, it hit an incredible 24%. In the past, it would have been sufficient to put your cash aside into a bank account and rely on the interest paid boosting your savings. But few banks now pay a sufficient rate of return to beat the consumer price index. And so we turn to the stock market. Not only does it offer the chance of capital growth, but income too. Those with a long-term savings plan should reinvest the income. Reinvested dividends have been the single biggest driver of equity returns in the UK, the US, and the European stock markets over the long term. Even Albert Einstein was a fan, calling compound interest one of the wonders of the world. He said, "He who understands it earns it, he who doesn't pays it." This is not to say that the stock market and other investable assets, such as bonds and commodities, are without risk. You can lose capital and income fluctuates. But the most important tool in your armoury is information, and this guide will help you build your knowledge so you can reduce the chances of capital loss and know how to deal with it when it happens. Investing is not for everyone, but if done correctly, it can help you buy a property, pay for your children's education, and protect you from pension poverty. Can you afford not to invest?
Next up, let's talk ISAs. The Lifetime ISA launched last week at the beginning of the new 2017-2018 tax year, offering a generous top-up from the government. But it's not the only way to get free cash from the state, explains Emma Wall.
Today sees the launch of the new Lifetime ISA, designed to help young people save for the long term. If you are aged under 40, you can open a Lifetime ISA, invest up to £4,000 a year in either stocks and shares or in cash, and the government has offered a generous top-up of 25% a year. Now, this has been very much applauded by the market, but it's worth noting this is not the only way to get free cash off the government. If you open a workplace savings scheme, a workplace pension, you get a top-up from both your employer and the government, more than doubling your savings power. And if you invest in a self-invested personal pension, you can get a top-up from the government for 20% if you're a basic rate taxpayer, or 40% if you're a higher rate taxpayer. One of the things that's unique about the Lifetime ISA is the fact that this cash can be used to buy a house up to the value of £450,000. However, if you're not a first-time buyer, you cannot access that cash until you're 60, and then it must be used in retirement. So make sure you're choosing the right savings product for you.
Are you looking to access your pension pot for income, but still saving for retirement? Take note, the money purchase annual allowance is changing, explains Nathan Long, Senior Pensions Analyst at Hargreaves Lansdown.
Hello, Nathan.
Hi, Emma.
So we're coming up to the end of the tax year, and if you haven't already taken advantage of your pension allowances for this tax year in your SIP and your workplace pension, what are they?
So basically you can pay in up to 100% of the amount you earn from employment or self-employment, and that's capped at £40,000 a year. If you want to pay more than £40,000, you can do, but you need to have unused contributions from previous tax years to allow you to make higher contributions. And actually it's worth bearing in mind that always the amount you can pay in is limited to the amount you actually earn.
And of course that's not changing from the next tax year, which is positive news, and neither is the lifetime allowance, although in previous tax years these have actually been reduced. But what is changing from April the 6th?
Yes, a key change that's coming in from 6th of April is the change in what's called the money purchase annual allowance. Now that's if I've accessed my pension either by drawing a cash lump sum, where some of that has been taxed as income, or if I've gone into income drawdown and drawn any income from that pension plan. If I've done that, then basically I will have my limit to how much I can contribute is going to go down from £10,000 as is currently to £4,000 in the next tax year.
And what are the implications of that for investors?
So that's a really big change, because actually if you are someone who is still looking to save for retirement, so we know people access their pension whilst they're still working, so if you've got plans to squirrel away more money before you finish working, it's probably best to look to sort of pay that this tax year rather than face a lower contribution next tax year. But it generally has quite big implications for people who are looking to work longer and longer, as we expect people will have to do so.
And what are ways of getting around this? I suppose one is to simply just leave your pension pot alone for as long as possible.
Yeah, absolutely. So don't access your pension. That's a that's a good one, but that's not always possible. Actually, one of the easiest ways to do it is to use income drawdown, but access only your tax-free lump sum. So if you take just the 25% tax-free lump sum, you don't actually trigger this lower allowance.
And for those individuals who do have the option to not touch that pension pot, they can perhaps use other tax-efficient savings vehicles such as ISAs in order to create that sort of income.
Yeah, absolutely. So if people have saved elsewhere, then fine. Obviously there's lots of people who haven't taken that step and may be looking to access, for example, their workplace pension, where this could potentially be an issue.
And if in doubt, seek professional advice.
Completely.
Nathan, thank you very much.
So you've decided investing is for you and you want to get started, but how do you do it? How do you start to build an investment portfolio? Emma Wall is back to explain.
First-time investors can choose between getting expert help from an advisor or wealth manager, or opting for DIY investment. If you are DIY investing, it is best to start with just a few lower-risk funds to help build up your confidence. As you add more investments over time, these first funds will form the core of your portfolio. Morningstar analysts identify the funds which are suitable for a core holding within a portfolio as part of their research. These are generally broad-based and non-specific. Many investors start with a multi-asset fund. Depending on your appetite for risk, you can choose between one that has an equities exposure of less than 35%, between 20 and 60% equities exposure, or a 40 to 60 exposure to equities. Typically, the larger the equities allocation, the greater the risk. These funds can be more volatile, but also offer greater returns over the long term. Additional investments display your conviction in a particular asset or region. For example, you could add a global equity fund with low volatility, which balances the geographical exposure for you, or a flexible bond fund, which allows the fund manager a wide remit within the fixed income space. Once you have these core funds in place, over time you can add more specialist funds, such as a fund which invests in emerging markets or commodities. Individual equity and bond holdings are more risky, but help to personalise your portfolio to your needs. For example, if you have a high conviction about a certain company or wish to boost your income payments. It is important to utilise your ISA allowance when setting up your portfolio. You can do this using an online investment platform. ISAs are wrappers which allow investments to be made exempt from capital gains tax or income tax payments. Most assets can be shielded in an ISA wrapper, including cash in a savings account, stocks, bonds, open-end and closed-end funds, as well as life assurance policies and ETFs. It's time to get started.
What is pension drawdown? Multi-asset drawdown portfolios can provide a steady income stream in retirement. How should drawdown strategies be used? And can they complement an annuity? Daniel Needham, President and Chief Investment Officer for Morningstar Investment Management, is up next to explain.
Hello, Daniel.
Hi, Emma.
So we're running a Retirement Week special. We're going to start with what exactly is drawdown?
Sure. I think drawdowns are a very important concept for those seeking to fund their retirement from their life savings. So effectively, drawdown is building an asset allocation strategy that's designed to fund people's retirement spending right through until their inevitable death, I guess. And so there's different ways that you can build multi-asset portfolios. And the way I would kind of simply describe it is that most multi-asset portfolios that people would be familiar with have been built for accumulation, that is maximising the amount of wealth that somebody has at retirement. Whereas drawdown is saying, okay, well, you've gotten your savings to retirement. Well, how do I then take them all the way through so I can fund my living expenses as I'm no longer working and saving, and also maybe even leave some assets behind for my family? And so that's the concept of drawdown. There's a few differences between accumulation and drawdown that are quite important when building drawdown strategies.
And of course, now that we're in a world of pension freedom, more people will be able to invest in these drawdown strategies. Having said that, they're not suitable for everyone, are they? Because there are some risks with drawdown, being that capital risk, unlike with annuities.
Yes, I think the UK, obviously with some of the pension reforms that have been announced, I think is facing a big shift in demand for retirement products. And so, whereas previously people have needed to take an annuity for a fair chunk of their pension savings, now they're going to have flexibility to buy different types of products. And in many ways, annuities are a form of insurance. I provide a lump sum up front, and that gives me guaranteed payments for life, assuming it's a lifetime annuity. Therefore, I'm removing the risk and uncertainty of receiving those payments. So provided I'm alive, I receive those income payments. For drawdown, it's different. You're investing yourself to build a portfolio to fund those payments, and so there's three main risks that people need to be worried about when building drawdown portfolios or when managing retirement savings. And the first is longevity, so outliving one's savings. So if you don't have enough in that pot, then that's going to be difficult to fund retirement. The second is what's called sequence risk. So imagine that you've been adding to your pot throughout your working life. Well, you stop adding to your pot at retirement and you start to draw away from that pot. And there's a mathematical sort of dynamic which is called sequencing risk, which means that if you have really negative returns early in your retirement, it significantly impairs your ability to fund your own retirement, because big negative returns early affect the amount of capital that you have later on, and that's something that isn't prevalent within accumulation, because you're adding to the portfolio. And then the final risk is inflation risk. So, changes in inflation reduce or erode the purchasing power of your savings. And so any drawdown strategy needs to manage those three risks. And I think depending on how much wealth you have or savings you have at retirement, those risks can be quite difficult to manage for individuals. And so annuities, we believe, can still have a role in people's portfolios. And so I would say the risk is that people throw the baby out with the bathwater. They move away completely from annuities, which I think would be a mistake for many people. And so there are risks that people, adopting drawdowns aren't able to achieve what they were able to achieve with an annuity.
And you touched on it there. Here at Morningstar, we're real advocates of the long-term portfolio approach to retirement income. That's maybe annuitize part of your retirement savings, use part of your retirement savings in a drawdown strategy, maybe have part as a lump sum. Using those things together, you can in part help to mitigate some of those risks you talked about.
Absolutely. I think often there's rarely one solution that's right for anybody. I think everybody has their own specific circumstances, and I think especially with retirement. So I think a much more sensible approach is to include a number of different tools within the retirement toolkit, and I think lifetime annuities still should play a prominent role. But I think having a multi-asset portfolio that's geared towards drawdown, that recognises it needs to produce a regular income stream or needs to be used to fund an income stream is important. I also think that people have that flexibility now to take some money out of their pension savings and maybe put it into a different account that's easy to access. I think it's complicated and it requires people to really think through what is right for them, and obviously the role of a financial advisor can be quite important with that. I think for those that are looking to do things themselves, they really need to do their homework.
Daniel, thank you very much.
Thanks, Emma.
How do you de-risk a portfolio in retirement? Morningstar's Director of Personal Finance, Christine Benz, offers a few options to investors looking to reduce risk but who are concerned about low-yielding, expensive bonds.
For Morningstar, I'm Jeremy Glazer. Many retirees and those about to enter retirement are looking for ways to de-risk their portfolios, but might be concerned about going into bonds or cash with very low yields. I'm here with Christine Benz. She's our Director of Personal Finance to look at some chicken ways of de-risking your portfolio. Christine, thanks for joining me.
Jeremy, great to be here.
So let's talk about maybe the first is the gold standard of how to de-risk, which is rebalancing, going into those stocks and bonds. Why do you think that this is still the best way to take risk out of a portfolio?
Well, first I would say there's a lot of confusion about what rebalancing does and doesn't do for your portfolio. Some investors assume, well, if they're telling me to rebalance, it must enhance my returns in some way. Not really. When we look at some of the academic research that's been done on the virtues of rebalancing, most of it points to rebalancing being a risk reduction tool. So the basic idea is that you're looking at your portfolio's asset class exposures and you are taking them back to your target allocation. And this has the virtue of helping you sell your most appreciated positions and add to things that potentially are a little bit depressed and maybe due for a comeback. So academic literature points to rebalancing being valuable from the standpoint of risk reduction. One thing to think about is that portfolios that haven't been touched, and I know a lot of investors have been pretty reticent to touch their portfolios and to sort of pull back on stocks when stocks have performed so well for so long, but the untouched portfolio is probably listing pretty heavily towards stocks at this point. So if you were 60-40 coming into this great rally that we've had in the equity market, so you were 60% equity, 40% bond, today you'd be roughly 80-20, and you are 8 years older. So that might mean that you should, in fact, think about scaling back on stocks and putting some money into the safer stuff in your portfolio.
But even with that big run-up and concerns about valuations, we hear from retirees who say, yeah, stocks are looking expensive, but bonds look even worse.
Right.
What would be a way to kind of do that rebalancing that maybe would be less painful?
Well, one thing to think about, and this is a form of rebalancing, but the idea would be if you have to figure out where you are going to spend from your portfolio, so if you're in drawdown mode, one idea would be to think about spending from your most appreciated portion portions of your portfolio. That will probably be your equity holdings, but use those withdrawals from those holdings to help meet your required minimum distributions, to help meet your annual spending needs. This is a way that I think retirees can maybe psychologically cope with this idea of trimming back on the appreciated pieces of their portfolios.
You say another option is to spend the dividends
Right.
that you receive instead of reinvesting them.
Right. I think a lot of us, I know me included, when I set up accounts, I kind of reflexively check those boxes that say, yes, I want to reinvest my dividend and capital gains distributions. But actually withdrawing those distributions can be a good way to kind of at least not add more to those positions that have appreciated. So this is something to consider with your equity holdings if you are in drawdown mode. It gives you a little bit more control over your withdrawals and helps keep you from plowing more money into securities that have already enjoyed a nice run up.
Another option could be to let someone else do it. What are some of the pros and cons of going for an allocation or all-in-one fund that holds both stocks and bonds and letting them manage that difference?
I've actually been critical of these all-in-one funds for retirees who are in drawdown mode, and the key point that I've made is that all else equal, you'd rather have some control over where you go for your withdrawals. So by having discrete stock and bond holdings rather than having them all under the hood of a single vehicle, you're in a position to actually say, well, today I want to withdraw from my equity holdings. Maybe in a few months, I'll prefer to withdraw from my bond holdings. You actually have more control. And I've run some back tests on this question about whether you're better off having discrete stock and bond holdings or using some sort of even a very good all-in-one fund. And I have found that there are some benefits to being able to do that very specific pruning from stocks or bonds at any given point in time.
Christine, thanks for your thoughts on de-risking today.
How does retirement spending affect withdrawal rates? Data shows that withdrawal rates get higher as spending decreases in retirement, explains financial planning expert Michael Kitsos in our next interview.
Hi, I'm Christine Benz from Morningstar.com. How does spending change over retirees' life cycles, and what are the implications for safe withdrawal rates? Joining me to discuss that topic is financial planning expert Michael Kitsos. Michael, thank you so much for being here.
Thanks, Christine. It's good to be here.
You and a colleague wrote a piece about retiree spending patterns, looking at how retirees spend over their own life cycles. Yeah. So I know there's a body of research in this area. Let's talk about what are some of the data, what the data tell us, and talk specifically about how when you look at the data, you do tend to see spending trail off a little bit as people get older.
Yeah, so there's been a lot of interesting data that's starting to come forth over the past 5 and 10 years. Some very good national data sets that look at spending behavior patterns, and even now some major financial institutions that can literally look internally
right.
at how do all their bank customers behave. And we're learning some interesting stuff. The prevailing view has always been people want to live a stable standard of living in retirement. I mean, the whole essence of a pension is built around you're going to get the same check every year for life. Hopefully it's an inflation-adjusted check, but at least an inflation-adjusted standard of living is going to remain constant throughout retirement. And now we're digging into the data and we're finding out it's not what people actually do. So your colleague actually here at Morningstar, David Blanchett, did a nice slice of this data a couple of years ago and found this effect where when we look at inflation-adjusted spending, what we find is as people get older, the spending trails off. It trails off by about 1% a year through our 60s, 2% a year through our 70s, and then another 1% a year through our 80s. So if you were kind of draw that, it's sort of it goes negative, more negative, and then a little less negative. So David called it like a smile, retirement spending smile.
Expenses at the end.
Right. So early on, our spending slows down a little as our lifestyle slows down. In the middle, our lifestyle slows down a lot. We get kind of the slow go years,
right.
Much less traveling, discretionary expenses fall off, and then even our 80s. We found the spending still trails off. So inflation adjusted, it starts slowing down by less. But even in their 80s, the data is showing that the average household spending continues to decline in our 80s, even with the uptick of healthcare, because the other stuff mostly our kind of our discretionary buckets, slows down even more. So, yeah, I have more healthcare spending, but we only need one car now. And those kinds of trade-offs that start shifting in the household means the spending continues to slow down even in the later years.
Okay. Let's take a look at the implications then for sustainable withdrawal rates, because a lot of the research there sort of assumes that, oh, yes, I'm going to need 4%, and then I'm going to inflation adjust that dollar amount over time, and it assumes a fairly stable level of consumption when, in fact, the data don't necessarily support that.
Yeah, the early safe withdrawal rate studies, and I've been guilty of this as someone that published to that literature as well. We were all essentially looking at replicating pension streams of income, which were stable, inflation-adjusting streams of income. And so we shot for the same thing in a lot of the research. And now we get all this data coming forth that says, well, actually, people's behavior doesn't match that. So we actually reran some of the numbers and published a study a couple of weeks ago about what does it look like when you actually assume decreasing spending by something like maybe 1% a year through retirement, or 10% a decade, or like maybe we stay steady for the first decade, but then we slow down the second and third. And what we found, no great surprise, your withdrawal rate gets a little higher when you assume spending decreases. Now, the interesting effect is it's actually not as much of a boost as maybe you would think. If you imagine, spending going down by 1% or 2% a year for 30 years, like that cuts 30 to 40% off your inflation-adjusted spending by the end. That's a big number. But what we found is the safe withdrawal rate only goes up a little. It goes from 4 to maybe something like 4.4 to 4.8. So we get maybe a 10 or 20% increase in safe withdrawal rate for what could actually be a 30 or 40% decrease in cumulative spending.
Okay, fascinating research, Michael. Thank you so much for being here to discuss it with us.
Oh, my pleasure. Thanks for having me.
And that's the end of this edition. We hope you enjoyed this program. From everyone here at Morningstar UK, thanks for listening.